All right, brilliant. Thanks so much, you guys, for having me today. So, again, as was covered in the intro, I'm going to be talking about a demo that I'm currently working on that I'm discussing with a few different hedge funds about what's the best way that you can use LLMs to kind of pull out these unstructured signals that help you figure out how prices are moving in different directions and try to sort of leverage, we use the word leverage a lot with LLMs, leverage LLMs to pull out those signals in a way that gets us to something concrete. I think that's the thing that we all struggle with is when you use large language models and they move non-deterministically, they give you these non-deterministic outputs. How do we kind of ground that? So this is sort of one use case, but I hope that you get to the end of this talk and it kind of like triggers a lot of different ideas about how you can take similar logic and apply to a lot of different use cases. And it's absolutely not limited to, mapping inflation and mapping and, meaningful, definitely beyond hedge funds for sure. So a little bit about me. My background, again, like most of you in this room, probably a couple years ago, you were not doing anything related to AI. My original background is in neuroscience, so that's where I got my start with machine learning. So I was using machine learning to study how the visual system in the brain understands how people move. So there are parts of your brain that will like light up when people are doing different actions. And that was basically my PhD. And once I spent so much time with machine learning in my PhD that by the time I got out of academia, I was like, this is all my brain can do. I just love the methodology. This is amazing. So I transitioned to the contract space, and I was creating these use cases, recommendation engine type things for different size businesses. And that was very, very, experimental stuff at the time. Definitely a lot of volatility in terms of the interest level. But then there was this question about, still how do we get the best meaning out of text data? How do we pull out meaning from text data? And if any of you guys in the room have been working in sort of with natural language processing, you'd know that like transformer models essentially came around in 2017. We started thinking about like attention and whatnot. So yeah, how do we pull out meaning? So while I was experimenting with natural language processing, we had the LLM explosion, ChatGPT was everywhere. I started experimenting with the first sort of LangChain type orchestration pipelines. I got scouted to work with pharmacy, with the biotech industry. So that's when I actually got started with my company, Genverve Limited, so that I could actually work in more kind of secure spaces. And it was, again, very, very experimental work. Late 2023, Insmed, this American company, was like, we want to build a domain-specific chatbot. Can you help us? And I was like, I'll try, because there was very little confidence that something like ChatGPT 3.5 could get you anywhere close to domain-specific answers. But actually, it didn't do too badly. And then if you were in the room here and you've done any courses on data camp, I have a course on data camp on designing agentic systems. That kept me busy through most of 2024. And yeah, I'm pretty sure a lot of you in the room are probably experimenting with LangChain, LangGraph, etc. So that's just a bit about me. So why am I talking about hedge funds today? Well, this is one of those fantastic use cases where you have to be like really precise about what you want to do. And essentially, if you are part of a hedge fund, if you're working for hedge funds, these organizations, what they do is they want to find these markers for price movements. So it could be kind of inflationary pricing or like price deflation. I'm going to keep using the word deflation a lot here. And we want to try to automate this process, because if you have a whole bunch of humans doing this day in, day out, it's really dreary work. It's really draining. Trying to keep it standardized can be very, very difficult. If you've got 10 people doing this with different documents, how do you even, what's your inter-rater reliability? How do you keep all of this consistent, right? I think sometimes we think so much about making things go fast that we kind of forget that actually when you have the same system doing this job, that you can kind of reduce inter-rater reliability, all this human variability that we keep introducing into systems. That's a pretty important part when you try and, nail down the numbers effectively. So a lot of this talk, you're going to see a lot of tables and you're going to see a lot of simple arithmetic. I hope I don't put you to sleep. Hopefully I can keep your attention for just the next couple slides. So I'm sure, again, you're kind of quite a few of you in the audience have seen images like this before, where we're talking about shared semantic spaces, right? So the idea here, this graphic, what I'm trying to represent is that we can imagine that each of these dots is a document about a specific industry, right? So we have the automotive industry, we have retail, and we have energy, oil and gas, whatever. We can have lots and lots of different categories. And the idea is that documents about these industries, if they're about the same industry, they'll kind of cluster together. What do I mean by cluster? So we have this like high dimensional numerical vector space. And so these documents are all represented by numbers, i.e. vectors. And so similar documents share similar spaces. Obviously, this is a a highly simplified version of what these things can look like when you actually visually render them, so to speak. So we're going to kind of exploit this high dimensional space and this concept of similarity and mathematically measuring this similarity to be able to predict the future and say something about prices in these different industries. So how do we get started? Well, we can get started essentially in a very what we can do is when we have our example documents. Let's say we have a lot of data that has been labeled. We know what domain it sits in. We know whether that document represents more inflationary language or more deflationary language. And what we can do is we can put them together in the same shared space, and then we can kind of we can create these centroids, mathematically create these centroids to represent what the archetypal document is. So even though I've only shown a centroid per domain here, you can actually imagine that we can have a dot, a centroid that represents inflation, and we can also have a dot that represents deflation in any industry that you want to kind of include in this sort of setup. So I hope that makes sense. So how do we exploit this? So again, we get started with historical data. We collect all of our past earnings calls, and then there are two camps. At this point, you can theoretically use LLMs for this task, but depending on how depending on what your preferences are, I would recommend that you get started with human labeled data, right? We're still early days with this stuff. So let's start with human labeled data, where we know what the cost driver is. We know whether the sentences are inflationary or deflationary. And what we will do is we will then embed those sentences. We will essentially convert them into vectors, and they'll be grouped by their cost driver and their direction. And so what we should have is something that looks like this table, right? So we've got these by the way, these sentences are incredibly obvious. Real earnings calls tend to be a lot more subtle than this. So freight rates have doubled. These are very, very extremely obvious sentences, but that's because this is all synthetic data. So this is what we want: a cost driver label, a direction, inflationary or deflationary direction label, and that's our starting point. So how do we turn them into centroids? Again, in this particular example, I've used again, small numbers, 15 examples for inflation, 15 examples for deflation. So we have total here, 180 sentences. And then what we want is we have them all grouped. So let's say, for instance, if you look at the raw materials category, you can see that if you read all of these sentences individually, you can see that they map onto raw materials. So the top example is inflation, the bottom example is deflation, And so we want these inflation, deflation centroids for each category. So how do we get to our embeddings? Again, should be fairly familiar. Here I'm using a very, very popular text embedding model, OpenAI 3 small. This comes up in like virtually every tutorial that uses OpenAI. This is like a very, very popular model. And you know, it's popular for a reason, because essentially what it does is it takes sentences, it turns them into vectors, and each vector has a magnitude of 1. And so what that does is you can take all of these sentences of different lengths, and then you can essentially put them in the same shared numerical high dimensional space, right? Now, so just to give you a bit more details. So we have for each category, this is what we want. We want an archetypal inflation centroid and an archetypal deflation centroid. So imagine these are those red dots in that earlier figure that I showed you. And yeah, so the critical part is that we get to these vectors, these archetypal vectors, by averaging the vectors in those categories. So this is an average vector that we have for each of these categories. And so once again, just to jog your memory, we want what we should have is we should have 2 different centroids for each domain, and one of them will be inflationary and the other one will be deflationary. So what do we do now? We've got our library, we've got our reference centroids. So what do we do when we have new data coming in? So let's take a new earnings call. So in this particular graphic example, let's imagine we've got new earnings calls coming in from these different domains. And essentially what we want to do is see how similar they are to our reference centroids, right? So we want to see, okay, is the new earnings call, is it net? Does it net an inflationary? Is the language inflationary or deflationary? And essentially what domain does it belong to, right? And we can do that by calculating similarity. Whoops, going a bit ahead. So this is sort of a little bit more of the detail. So we use the LLM that we have our new earnings calls coming in. We have an LLM that extracts, that labels our new earnings calls, and we get structured, categorized cost signals, and we get them from our unstructured earnings calls. And then what we do is we have them split into sentences, and we are looking for an output that looks something like this. So let me show you what that should look like. So this is simply how I've set it up in my demo, right? So each sentence has a label, each sentence has a category label, and it has an inflation type label. And for the new earnings calls, I'm getting the LLM to do this. I'm getting the LLM to do this labeling for me. Now that we've got that categorization, we can convert the new sentences into embeddings. We can convert these sentences into embeddings that we can then map onto our reference patterns, right? And then we can calculate the similarity. So I'm sure some of you guys are already, again, familiar with basics of the cosine similarity formula. It's that angle. You're calculating the angle between a pattern that, pattern A and pattern B. And then you can calculate the cosine similarity angle between those two in this high dimensional space. So for each sentence signal, we're calculating the cosine similarity with the inflation centroid. We're calculating the similarity with the deflation centroid. And then we have a net score, which is just the inflation similarity minus the deflation similarity. Higher the net score, more inflationary. Lower the net score, more deflationary. not too complicated. So again, just to give you a bit more of a visual here. So this is what it would look like for our categories, right? So we've got these individual sentences, and we are calculating to get our net score. We have our the similarity for that sentence compared to the inflation centroid, the similarity of that sentence compared to the deflation centroid, and then we just do the simple subtraction. Now, a little bit more averaging. So, right, in a real life use case, you won't get one sentence per category. You will get lots of different numbers of sentences for these different categories, right? So what I've done here, and this is entirely open, you can play around with this idea depending on what you think is the best thing to do. But here what I've done is I've given equal weighting to each category. So that means, what does that mean? That means if in an earnings call, I've got two sentences, signal 1, signal 2, then each sentence gets half the weight. If a category only has one sentence, then that sentence will carry 100% of the weight, right? Does it have to be set up this way? No, I'd be curious to hear your thoughts. I'm going under the assumption that for my particular client, the client that I want to show this to, cares equally about each of these categories. That's the assumption here, but it doesn't have to be that way. So how do we get to the aggregated score? So again, the aggregated score is just averaging. It's averaging across the sentences for that category. Again, I believe I covered. Yeah, I don't think I need to expand on that very much more. Yeah, again, why would you do that weighting? Why would you sort of do all of this averaging? It reduces the impact of outlier sentences. So if you want to make sure that your scores are not overly driven by a single sentence, you can treat the sentences in that document this way, so that you have a much more balanced numbers, so to speak. So finally, we get to an overall score calculation. So all category scores are combined. We have a single overall inflation score that essentially applies equal weighting across categories, and it's a unified measure of inflation. And again, these are sort of the arbitrary thresholds that I have set for this particular demo. Yeah, so what does that look like? So let's say we have 6 categories, and we have these scores, and each category gets 1/6 of the weighting because we have 6. And then we essentially average to get our final net score. Yeah, this is basically just doing the same thing. It just breaks it down even further. So yeah, this is that final score. So what do we get out of all of this? So again, we have the LLM that extracts the cost driver, the direction, the direction of the language. We're able to map new sentences and new earnings calls onto historic data. We have a library to compare against. And the net scores quantify inflation versus deflationary language. And it produces, hopefully, interpretable sector-specific scores. And there, I'll go into a spiel, I'm sure in the question period, I'll go into some details about how I think this can vary a lot based on what your specific objectives are. So some of the advantages, I mean, pure keyword search. I mean, you know, you're going to miss a lot of details if you just go by pure keywords. That's going to assume that, you know, you're not going to necessarily pick up any nuance. So you'll be fairly limited if you were to just do all of this with pure keywords. Theoretically, you could also do this kind of thing with some of the some of the kind of earlier transformer models, something like FinBERT. So if you've worked in the financial sector, you might be familiar with a transformer model called FinBERT, and that is essentially that model can be used to classify what I would call good vibes versus bad vibes in the sort of language of market shifts. But does that necessarily map onto price inflation or price reduction? That's not necessarily the same thing, right? So this is us just kind of trying to get our fingers into the numbers a little bit more. And yeah, if you wanted to, you could theoretically train your own model to do this kind of thing, but then that obviously training models from scratch is extremely laborious. Why would you do that? Why is anybody training their own model right now? Like, you really need to make sure you go through all of the other much easier, much more straightforward things before you go, oh, I need to train my own model to do this. So this is a hybrid method. It combines the flexibility of LLMs, it's embedding based with numeric scoring, and also we're not asking the LLM to do the entire job. If we can, we're using math here to do quite a lot of the, the averaging and stuff. Like, you use the LLM for the parts where the LLM could actually be useful. And it should be possible to easily extend this, and it should help with auditability. So how would we refine this? There's lots and lots of different ways to change what I'm going to show you right now. You can imagine that this sort of demo could be adapted to different sectors so that your final scores are not influenced too much by categories that don't matter. So it might be the case that if you're working in pharmaceuticals, there's an entirely different profile of costs that drive costs in the pharmaceutical industry. But if you work in oil and gas, then that could look completely different. So you could absolutely have very, very tailored sector-specific versions of something like this. And you can incorporate a dashboard that looks at time series, compared to the past, and develop a profile over multiple years, and helps you map historical data, right? So that being said, I'm just going to try and switch over now and show you what this looks like. So just bear with me. Okie dokes. So again, everything that you're seeing here, all of this is synthetic data. So if you do work in the financial sector and you're like, none of this looks remotely authentic, that's a perfectly fair, that is a perfectly fair criticism, because a lot of the sentences that you're going to see are incredibly on the nose, and real earnings calls tend to be quite a bit more subtle. So here on the left-hand side, I have synthetic earnings calls from different sectors that I will load and show you how this works. So I'm going to load a sample, and it'll take its sweet time. And here is what we have. So here for this blurb, for this earnings call blurb that I uploaded, I have identified the cost signals. The demo has identified what the cost signals are and the direction, inflation or deflationary language. So that is one first pass we can look at. And then here we have this table, which, let me show you what that table consists of. So you can see how we have different sentences that are mapped to different categories, right? So we've got different categories, and here at the bottom, this is the aggregate. So it's like telling you, okay, we have 27 sentences in total, and here are the different sentences that get grouped into these categories. And let me scroll over to the right. And so you can see for each sentence what we have. So we have the net score, the contribution. So here's what I was talking about with the weights, right? So we have different weightings for the different sentences. All right. So if you see a category that says 33.3%, most likely what that is that that's 3 sentences that contribute together. There are 3 sentences in that category that contribute together to the 100% weighting for that category, right? So in here, this is the contribution. So the contribution score can be inflationary or deflationary, and that can be per signal as well. And then if you go down here, it's picking out, we have a category breakdown, and this is basically just picking out the things that have a magnitude of 0.1 and above. So if the particular category does not reach that threshold, you're not going to see it in the category breakdown. And then we have our averaged net inflation score for that whole earnings call, right? So yeah, so that's basically, that is what I have to show you. Let me just load up some other examples. So yeah, we go to so this is retail. So again, because I used ChatGPT to generate these this raw text for me, you can see that it's got some pretty obvious sentences here, like, oh, our textile costs for apparel increased by 18% due to cotton price volatility. Very, very on the nose, very on the nose sentences for sure. So yeah, it's basically doing the same thing. So here, we've got a big spread of inflationary categories that are going to be driving costs. Yeah, again, going back to that statement about how to. This is what I would think of this as a good starting point, because if you were to kind of start showing this to different types of clients, they will absolutely have most likely very, very domain specific questions to ask. So you can imagine that you might have a client who is exclusively looking at investing in GPUs and the tech sector, and they don't care about cotton, they don't care about textile. So why is it in the model? You don't need it. You don't need anything related to sort of cotton or raw materials pricing and different agricultural sectors, for instance. So you can create something that is quite nuanced and quite unique, depending on who you want to work with. And yeah, that's me done. I will load the screen again. Thank you so much. Any questions? Yes.
Record. First off, thank you for your talk.
Thank you.
I have a question about the use of embeddings for the kind of signal of the, like, almost the mini reward function of the thing you're doing. And the decision not to use, for example, market data or other realized data or performance of the events after the earnings call.
Yeah, so this is an earnings call example because of a specific interest in one of the hedge funds that I was speaking to. So yes, absolutely. The raw data does not have to be earnings calls. It can be, the Bank of England. It can be, Federal Reserves. It can be any, you can sweep the internet for any data that you think is relevant. So yeah, that's a really good question. And absolutely, you can expand it to where your client thinks the best data is for your particular example.
I actually more meant, for example, if you use for example, the stock price post-day earnings call, you could use the stock price as almost like a reward function as well as the embeddings, because then you have a realized event.
So sort of like using using stock prices from specific time points to like as weightings almost, like could you?
Not as weightings for the embeddings, but post earnings call, you'll have an increase or a decrease.
Yeah.
you will have almost a sentiment score from the work you've done. Yours is very tied to the embeddings, and those embeddings have been kind of manufactured. So the performance of the model, to me, it would feel like it's very much capped at the performance of the embeddings that you've pre-gave it. Whereas you could move more into somewhat more supervised learning by giving it. Okay. Have you done anything like that? So this is more my question.
No. So interestingly, the first version of this that I did kind of the opposite of what I showed you here. So here, there's a lot of averaging going on. So it's a lot of like averaging the signal across, which this was inspired by a conversation I had with someone who worked at a small hedge fund, where I was trying to make the case that actually, if you take a company like Apple, for instance, like in their earnings calls, there might just be 1 or 2 sentences that actually carry the whole signal, and the rest of it, none of it matters, right? So you can do this, but like pick out the max sentences, like literally max, just pull out the max similarities and then forget the rest, right? So it's sort of like these are domain kind of judgments, right? So one company, one hedge fund might choose to average across lots and lots of text and embeddings, and another company might be like, we're looking for the strongest signal. It'll have different impacts for sure.
Gotcha. Okay, thank you.
Yeah, basically giving equal weights to all parts of the earning call can be a little misleading, right?
Yeah. That was
the whole thing.
Yeah, exactly. Yeah. So this is think of this as like this is domain agnostic, right?
Some parts might carry like more weight, right?
Absolutely. Yeah. So because if you look at the categories, as I mentioned, so if I were looking to invest in H&M, or I don't know, some publicly traded like retail company, right, that only sells clothes, then I'm not necessarily going to care about healthcare, like pricing. Like that doesn't even have to be in the model.
Like
right? So,
even in healthcare, let's say we're talking about just healthcare.
Yeah.
You have like an earnings call about healthcare.
Yeah.
But it's still some parts might like have some gibberish, normal talks, and some parts might have different kind of important sentences. But it should carry more weight, right?
Yeah, absolutely. And you can absolutely discuss that with your client to be like, okay, which things should we historically like buff? Shall we multiply the weightings to overrepresent some domains over other domains? So yeah.
Any other questions? Yeah.
Yeah, thanks for the talk. I just have a question. So kind of in the talk, like we tried to retrieve the inflation or deflation rate from the text. But actually those numbers come from government statistics agents, don't they? And why do we want to mine it from text? Is it kind of for perceived inflation?
Yeah. So this is, so if we look at who are the people that go to hedge funds, right? Like the people that go to hedge funds, they're basically not, so the safe way to invest in the stock market would be, I'm going to pick, I don't know, the S&P 500 or something. And it's like, oh, it's a big fund of like lots and, it completely spreads your risk. And that's the safe way. That's a very safe way to invest in the stock market. But the people who go to hedge funds, these are high net worth individuals. And what they are looking for is they're looking for these like niche kind of very, very sector specific, not super publicly known information. And so earnings calls are one example. But absolutely there could be, the text that can be used to do this can be spread over lots and lots of possibly, I don't want to say classified, but probably some classified documentation as well. It's entirely down to what you have access to.
Any other questions? Okay, I've got a quick one as well. So if you take the outputs of a specific earnings call, that will give you one signal on that particular company, but then of course there's lots of different companies performing differently. So is this something which you would aggregate, over time in order to create more of a kind of signal on potential macro market movements? And so you're kind of averaging again?
Yeah. So that's the thing, right? So this is, I don't have a specific policy on this, because I actually think that, what do you want to do, right? You want to invest and you want to make returns, right? So what's the best way to do it? Ideally, you would be specific about where you're investing, specific about what those industries are. And then the way I would go at it is I would want to know what the highest signals are. Mm-hmm. So I would actually probably, especially for a very long-term scenario, I would go the searchlight way, where I would look for the highest signal sentences. But you're absolutely right, where if you just kind of keep snowballing the averaging, the signal's just going to get smaller and smaller and smaller and smaller. Yeah. It's going to be really, really hard to pick out anything meaningful. So yeah.
Okay. And then also a question about when you create these archetypes, they'll be based on a certain category of language which is appropriate for that moment in time. But then there's things that change in the market. I think recently a lot of earnings calls would be talking about tariffs, and that would be something which wouldn't have been there, a year ago. So how often would you need to update those archetypes in practice? And is that?
I'm not to get too political here, but with the current U.S. administration, maybe daily. It just seems like there's macro relevant information coming out through the media, probably as frequently as you can afford to.
Yeah. Okay.
Right. I mean, news is moving much quicker than it used to, like 15, 20 years ago. So.
Okay. Cool.
Yeah, thanks for that presentation. Just a few observations. It kind of seems to me that, this is very useful, but it would be really nice to have something that could also take account of inflation that was historic and inflation that was kind of expected, like forward-looking. And I guess another thing might be, what kind of time horizons are we looking at? Because like earning statements probably every quarter. So like management, are they discussing, are they thinking about when they measure inflation, are they talking about 12-month kind of horizons, or just over the last quarter? Those, but I think those kind of things could kind of really help.
Yeah. I mean, I think that's going to also like change. That's going to be different for different industries, right? Like certain, my personal subjective impression of like the tech sector right now is that it shifts very quickly, very, very quickly. Like there's a lot of movement happening. So if you were to work with a client who really wanted to invest in tech stuff, you'd probably want to update fairly quickly. Live, like, the centroids could not stay the same for a sector like that, for sure. Yeah.
Great. We'll have one more question. I think we then have to wrap up.
With the weighting, so you've set them as static and even for this example. The market's obviously changing. For example, an earnings call from Apple will have a much larger impact, and there'll be spillover from the volatility versus like a smaller consumer goods company. Can you set the weightings to be more dynamic and ever changing, but also like take into fact the previous like inflationary, deflationary score you've assigned to it? So it's constantly changing depending on the category.
Yeah, absolutely. So one way that I like to think about it is, so if you have a portfolio, depending on like how, like what's your pie, right? So if you yourself have an investment portfolio and there's like different percentages that you have electively decide, okay, 20% of this portfolio is going to be, I don't know, NVIDIA, and then like 10% is something else and 5% is something else. No. And you make those decisions explicitly. then you could theoretically map your pi percentages to the weights in something like this, and then that's like an explicit decision that you can make. But I'm sure you can also, I mean, we have auto trading bots, right? So I'm sure you can have a situation where, depending on where the inflation or deflation signals are going, you like automatically update the weights however you want to, however you think is important for you.
Thank you.
Great, thank you. I said no more questions, but I'll take the liberty of asking one more. You mentioned earlier that you were starting out with ChatGPT 3.5, and more recently, have you continued to use ChatGPT in the hosted models, or have you been leveraging more open models with your with this particular use case?
So, because of nothing like this is in, for me at least, I've not put anything into production. So if if this ended up being something that like tons and tons of companies were using all the time, then of course I would look into, smaller models and whatnot. But of course we have that trade-off of like, okay, you go a smaller model and it's not as smart, or, from what I've gathered, small models are good for these very, very specific tasks. So if you have a very, very extremely well-defined task, you could probably save a lot of money using a small model or an open source model for that. But for something like this, where the sentences could be anything, go with the model that is going to give you the best signal.
Okay, great. Well, thank you. Great talk, Dilini. And
thank you.